Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Goldman Sachs India Equity Fund. India is a very interesting country. It is the 7th largest country in the world by land area and houses the most population of over 1.4 billion people, or roughly 1/6 of the world's population. More importantly, while it has the highest population in the world, median age is only 29.5 years in 2023, which is much younger than the next most populous country, China's 39.8 years. This translates to a huge working population for the next few decades, which is economically beneficial. While India's complex and diverse web of ethnicity, culture, and language, further complicated by its sometimes inefficient democracy processes, has made India pursue a slightly different, and some might say slower pace of modernization route, India has nevertheless established itself as a strong performing equity market for offshore investors in recent years, suggesting ample investment opportunities available for those willing to explore this country. On past 5-year basis, the MSCI India IMI index delivered 13.12% per annum, outperforming the MSCI All Country World IMI index of 10.68%. The years of strong performance has, however, led to India equity market becoming one of the most expensive market by pricing matrices. As Aswath Damodaran, a well-known finance professor at NYU Stern School of Business, recently mentioned in his blog, no amount of hand-waving about the India story can justify the high pricing matrices. This has resulted in a market correction since October 2024. Using Amundi MSCI India 2 UCITS ETF as a proxy, the market has corrected almost -20% till date and doesn't seem to have bottomed yet. But as what goes up must come down, what goes down should come up again. If there are no fundamental problems with India, this correction would be more a market revaluation process and will eventually stabilize and the market will recover. A -20% looks scary, but India has gone through many more severe market corrections in the past, with a -70% during the 2008 financial crisis and a -40% at the start of COVID period, to name a few. Therefore, India equity market presents itself today as an investment opportunity worth considering and monitoring. The questions are, how much more correction will you wait for it to be cheap enough to enter, and whether you are greedy enough when others are fearful. With that, let's go through the fund for today's video. GSAM stands for Goldman Sachs Asset Management, which is part of the asset and wealth management business of Goldman Sachs, a US financial firm best known for its investment banking capabilities, but has also been aggressively growing its private wealth business and asset management solutions over the years. Based on the 4Q 2024 financial reports, asset and wealth management business has over $3.1 trillion worth of assets under servicing. 38% of the assets are fixed income, 27% liquidity products, and 25% equity solutions. Majority of the business comes from US at 71%, and public funds that refer to mutual funds and ETFs comprise 32% of the assets. Specific on public funds, GSAM has over 35 years of investing experience and hires over 1,000 investment professionals globally. There is no country-specific information available for GSAM though. The Goldman Sachs India Equity Fund is one of GSAM's top solutions and is currently a Spotlight product. There is a dedicated Spotlight page in the GSAM website that covers an overview of the India equity market, and as well elaboration on 3 key megatrends on why the GSAM team believes India equity is a worthy long-term investment. The fund has received multiple awards over the years given its decent performance, which we will go through in more details later. The Goldman Sachs India Equity Fund is a sub-fund under the Goldman Sachs Funds SICAV fund family that houses over 30 funds. Goldman Sachs Funds SICAV is set up as a Luxembourg SICAV company structure and is UCITS qualified. Singapore-wise, the fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. Trying to find out information on GSAM funds is a bit of a challenge. The fund-specific page in the individual investor website funnily doesn't contain the fund objective, and I have to go to the financial intermediary website to grab this, which doesn't say much except that the strategy is capital growth focused and that the companies invested can be based in India or their businesses deriving majority revenue from India. The fund fact sheet similarly doesn't say much except indicating the fund may exhibit a higher return and higher volatility than the benchmark, which implies the fund portfolio can deviate from the benchmark. The benchmark of the fund is MSCI India Investable Market Index, or IMI in short. This index has 683 constituents from large to small caps and covers 99% of the investable India equity universe. The Singapore product highlight sheet provides a little bit more wording on the fund strategy, though a large chunk of it relates to ESG considerations, which I think is not crucial for this fund as it is not ESG focused. There is a paragraph stating that the fund will not invest more than 1/3 of the portfolio in non-equity investments, which gives it enough flexibility to reduce equity risk if and when the equity market undergoes major corrections. The prospectus provides more details, particularly on the types of non-equity investments that the fund can go into, such as other permitted funds, derivatives, and bank deposits. One useful section in the prospectus states the fund is not expected to deploy any leveraging in the portfolio. This information is sometimes quite hard to discover in funds from other providers. GSAM unfortunately doesn't provide any elaboration on the investment process, except a mention in the spotlight page that the team conducts over 1,000 company meetings per year, which implies there is some form of bottom-up fundamental analysis being done. Perhaps this is combined with a top-down macro view that is expressed through the megatrends that the team believes in. GSAM also publishes occasional short blocks of macroeconomic views from the team. These provide some insight into what kind of investment opportunities and risks the team finds on the ground in a broad sense. Fund portfolio data and statistics presentation, on the other hand, is comprehensively available, and GSAM does it quite well, squeezing a lot of this information into the fund fact sheet. Using the January 2024 fact sheet, we can see that the fund was incepted in March 2008 and has by now gathered over $4.8 billion worth of assets. There are 116 holdings in the portfolio, which looks a little too much for an actively managed equity mutual fund. However, looking at market cap breakdown, we can see the fund is currently overweight in small caps, with about 31% exposure. Hence, it is understandable that the fund would spread out individual holdings risk and volatility by holding more small cap stocks with lower exposures in each one. The fund maintains over half of the exposure in large caps to keep volatility and market alignment in check. Despite having full discretion to deviate from the benchmark, sector allocation actually is quite similar to the MSCI India IMI index, with financials, consumer discretionary, technology, and industrials taking the top positions. There is an overweight on consumer discretionary sector, which is in line with the Make in India and Affluent India megatrends highlighted in the spotlight page that talks about increasing consumer spending and more focus on domestic production. Top 10 holdings look quite well diversified across industries and look to be well-established market leaders in their respective fields. Fund manager information is oddly missing in the fund-specific page and fact sheet. The financial intermediary website gives a very generic one-liner talking about what I presume is in the broad equity team, which is not useful at all. Fortunately, there is an interview video of Hiren Dasani, co-head of Emerging Markets Equity Team, in the Spotlight page, so we know who is running the show in this fund. There is not much information available on Hiren on the web, though Morningstar website shows he took over the fund from Prashant Khemka in 2017 and is the sole manager for this fund in the past 8 years. Hiren appears to be dedicated to India and emerging markets equity products in GSAM. Referring back to the Spotlight page again, there is a mention of 9 locally based team members that I assume to be the research analyst team supporting Hiren. While this sounds like a small team, the 19 plus years of average industry experience suggests there is sufficient knowledge and skill expertise to help support the performance of the fund. India is still a relatively under-researched market, especially with the small caps segment, so having a strong local team helps immensely. The broader Goldman Sachs franchise also has 3 physical offices in India that can help to provide different and complementary business viewpoints of the India market to the team. The Goldman Sachs India Equity Fund has had a good long-term performance that has shown the fund steadily improving returns versus the benchmark over time. Looking at calendar year returns for the past 10 years, it can be seen that the fund does run a higher return, higher volatility portfolio compared to the benchmark, as per stated in the fund fact sheet. The fund clearly underperforms during bad years and outperforms during good years. This is likely attributed to the overweight in small caps in the portfolio. The same is observed even when comparing the fund against peers. In this case, using Morningstar as a reference, the fund is usually first quartile in good years and fourth quartile in bad years. The fund has comfortably outperformed the usual India ETFs available in the market since inception in 2008. Outperformance is less prominent looking at past 5 years, but nevertheless, it is still decent for an active fund to beat the ETFs. Let's compare against other mutual funds peers next. On 10-year basis, the fund looks to be one of the better performers, trailing behind only Ashoka White Oak and Manulife. However, some of the funds do not have a full 10-year track record, so not all return numbers are correct here. On 5-year basis, only Allianz and Ashoka White Oak have done better than Goldman Sachs. On 1-year basis, Allianz stands out as a strong outperformer and somewhat an anomaly, while the rest are all quite similar in returns. Finally, on year-to-date basis, all the funds have corrected in various magnitudes. And as expected, Goldman Sachs is one of the weaker names here in a bad market. While there is no clear winner within the mutual fund peers, looking at historical performance, it does show that the Goldman Sachs India Equity Fund tends to have a decently strong performance during market rebounds and recoveries. And the long-term trend still shows the India equity market remains on an uptrend despite the current market correction. Hence, I do think the fund remains a decent candidate to consider for investors awaiting for an entry level to get into the India equity market. Share classes for GSAM funds tend to be quite straightforward for retail investors. The usual retail share class is called base share class that normally refers to the base currency class of the fund. Non-base currency classes are called OCS share class, that means other currency shares. There appears to be only 3 share classes registered in Singapore for retail investors, that are the base US dollars, OCS Sing dollars, and OCS Hong Kong dollars classes. The OCS classes are unhedged, so there will be some small performance differences due to FX. The base US dollar class is incepted at fund launch in 2008, while the Sing dollar and Hong Kong dollar classes were incepted only in 2019 and 2023 respectively. All 3 share classes are accumulation class. While the fund does have distributing share class, the strategy of this fund is long-term capital appreciation, so it doesn't make sense to consider distribution at all. The fund does have other OCS classes such as Euro and Sterling that are offered to accredited investors. Management fee for the base and OCS classes is 1.75%. Up to 62% of the management fee can be paid by GSAM to distributors as trailer fees. Adding other expenses gives a TER of around 1.95%, which is slightly higher but still within the norm, as this is a single emerging market country strategy. Distributors are allowed to charge up to 5.5% subscription fees, though I think anything more than 2% for equity funds is excessive. Finally, let's summarize our findings. The India equity market is currently undergoing a revaluation correction, while long-term fundamentals remain decent. This provides an opportunity to look for an entry point to invest into the market at a cheaper level. The Goldman Sachs India Equity Fund is one of GSAM's flagship products since launching in 2008. There is a clear effort through the Spotlight page to ensure the fund remains well advertised to investors. While this fund runs a straightforward single country equity strategy, there is no elaboration on the investment process. Providing some overview on the stock selection criteria and research team involvements would be good for investors to understand the fund better. The lack of fund manager information is puzzling. Considering Hiran is the key person for the fund, he definitely deserves more mention and appropriate credits. Performance of the fund is a key factor here. With a long track record since 2008, the fund has exhibited its ability to outperform the benchmark and various ETFs, which means it is worth paying for the performance alpha. Comparing against other mutual fund peers gives a more mixed outcome, which is partly due to the fact that the fund tends to run a higher octane portfolio that does better in good markets and worse in bad markets. While the increased volatility is not ideal, the current market opportunity favors a fund that can deliver higher returns in the market rebound or recovery stage, and therefore, this fund has a decent chance to shine when that happens. All in all, as an established mutual fund in this category, I think it is a decent candidate to consider for an opportunistic entry play into the India equity markets. This concludes my absolutely biased comments on the Goldman Sachs India Equity Fund. If you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.